Good morning and welcome to the UTILICO Emerging Markets Trust PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Lead Fund Manager Charles Gillings. Good morning to you.
Good morning, and thank you. And thank you everybody for joining us for our sixth Investor Meet presentation. Certainly time flies, and it's good to see progress within the portfolio, but also the opportunities that are emerging and continuing to emerge. At the start, we just wanted to retrack over, if you want, why we at UEM find the emerging markets attractive, given their structural growth drivers, the infrastructure mega trends, and attractive valuations, certainly at the moment. And we'll unpack each one of these in the presentation. And we'll also seek to address why UEM. We firmly believe that our differentiated emerging market portfolio, our resilient portfolio, it's certainly stood the test of time and outperformed the emerging market index. And the way we construct the portfolio, I think, has a bearing on that outcome. So sharing that as well. And talk a little bit about the dividend profile and outlook. If we turn to the next page, Mark. UTILICO Emerging Markets, at a really high level, we are, top left, asset focused. What does that mean? Our investments are into infrastructure, utilities, and communications assets, but they're operational infrastructure. So we're not buying, if you want, 100 acres and seeking planning permission and development risk. We are investors in businesses that are already up and running and can demonstrate their capability to deliver the returns that we expect over time. I think the second point to just note on assets is 96% plus of the portfolio is listed. So not only do we have a higher bias to operational assets with cash flows, but we have a very high bias to listed investments. Top right, we are emerging market focused. That's our key, if you want, driver. And I always say to shareholders, we will stay fully invested. Shareholders may well decide from time to time to go overweight or underweight emerging markets, but we will, as the fund managers of UEM, remain fully invested. Bottom left, active management. What does this mean? This means that we devote a lot of time to understanding the business model, to understanding the management, to understanding the country in which we're making the investment. And we engage with management teams, we engage with the local business environment to make sure that the expectations that we set can be delivered and can be achieved. We're long-term, bottom-up. What does this mean? It means that we end up with a benchmark agnostic set of investments. We are not driven by, if you want, trying to mimic or marry the MSCI index or any other index. We're looking for the best investments we can find and put them into our portfolio. Highly experienced management team. On the call with me today, I've got Jacqueline Brewer, who is Deputy Portfolio Manager, been with me over 10 years. Mark Labelle, who looks after communications and has been with me since the setting up of ICM. And the rest of the management team offers a huge amount of consistency and an experience, and that is invaluable. Bottom right, just to note, we've outperformed the MSCI over 3 years and since inception. While we may, from time to time, fall behind on a quarterly basis, I think if you looked at our performance, we perform over the long term and with lower, if you want, beta and more alpha, which means that we are good at finding investments and putting them into the portfolio. We pay a quarterly dividend. I think that's a strength, and we can come on to the amount that we pay. But that just gives you a feel for UTILICO emerging markets. So we mentioned, if you want, why do we like the emerging markets? There are a number of fundamental pillars which underpin the emerging markets. Positive demographics. A lot of these countries have a young population, a growing population, and if you want, a population that is going up the education curve. And those demographics certainly feed through to strong drivers within those local economies. We are continuing to see increased urbanization. If you looked at Vietnam, their urbanization rate today, I think, is approaching 40%, but there's no reason they won't continue up that curve. And that urbanization, if you want, is leading to the rising middle class. And it's the middle class that are demanding asset quality and, if you want, the benefits of going up the economic curve. I think the fourth pillar that we would always mention is strong GDP. I know a lot is discussed about GDP under Trump 2.0, etc. But the reality is most of these economies are growing strongly and will continue to grow strongly as the governments invest in the infrastructure assets to out the growth opportunity. We've identified 4 megatrends which accelerate the outcomes, if you want, of the fundamental structural drivers. So social infrastructure. As I mentioned, the middle class is looking for better outcomes. And so you're seeing improvement in sanitation, in water, in transport, and all of that is driven by the demand from rapid urbanization and the middle class. And we're seeing a number of governments pursue policies to drive that social infrastructure. I've just been in Indonesia with Mark, and it's very evident that while the government to date has been focused on hard infrastructure assets, they're definitely focusing in on soft infrastructure, so schools and hospitals. And all that infra investment leads to opportunities for us. Energy growth and transition. All economies are, all nations are looking to move to a greener profile. And that clearly offers us opportunities as they invest in wind, solar, hydro, and other, if you want, decarbonization of the energy matrix. And we're seeing that across the emerging markets. And that, if you want, is overlaid on the top of needing to grow in order to deliver the economic growth. One thing that we've observed over the decades is that if India's growth is 6 or 7%, their energy growth actually needs to outstrip that in order to deliver the future growth that they are looking to achieve. If you then overlay the decarbonization matrix, you can see there is a very strong driver behind energy growth and transition. Clearly, energy security has gone up, if you want, the political agenda. And again, that needs new investment to ensure that nations can increasingly be energy secure. Digital connectivity. We all know about the shift to the digital economy, the acceleration through COVID, but this continues to be an area where investment is happening at pace to deliver, if you want, the opportunities back into the economies. And while it's clearly a feature in the developed markets, it's even somewhat a bigger feature in the emerging markets because they're starting without legacy, but the real opportunity to drive in, if you want, the digital connectivity. And things like AI, which need large infrastructure and cloud-based data, mean that if you want, there are lots of opportunities for us in fiber, in data centers, etc. So very exciting to see. Global trade. I know a lot is talked about in terms of Trump 2.0 and what does that mean and how does it impact on, if you want, the emerging markets. What I would observe is whichever way Trump goes, the likelihood is that we'll see a shift in supply chains, and that shift should deliver opportunities to us. Certainly, Trump 1.0, we saw increased trade and activity as countries traded between themselves in order to both meet internal demands and expectations, but also to meet the global supply chain expectations. So again, above average investment taking place. All these mega trends we believe will last for the next 10 years and therefore offer us a huge tailwind to the portfolio.
Yeah, so Charles has obviously covered why we like emerging markets, the structural fundamental growth drivers of EM that we're seeing, and also that overlaid with the infrastructure megatrend that we're seeing. But sort of the third reason why we like or continue to invest into emerging markets is that emerging markets continue to be attractively valued. If we look at the emerging markets cyclically adjusted PE ratio, I mean, we can see that it's trading at around roughly the 10-year average of around 13 times PE. And then when we look at the S&P 500 index, I mean, at the moment it's trading at around 34 times. Admittedly, a lot of that is the inflows into the limited tech companies of the Magnificent Seven, but still we can see that emerging markets add or give us a lot of value on an absolute and relative basis. And then if we overlay that at where UEM is currently trading, frustratingly, UEM is currently trading at around a 22% discount. That has narrowed though over the last few days. It's now around 17%. And as we'll come on to, UEM offers a very leading performance as well as a very strong dividend yield of around 4.4%. And as Charles has already mentioned, we have a very good low volatility in the portfolio. Our beta is around 0.8 times. So at the moment, UEM itself provides a very interesting or very compelling entry point for new and existing investors. And then if we move on to why we should invest in UEM or why investors should invest in UEM, if we move on to the next slide, Mark, you can see that we have an incredibly resilient portfolio. We have a very resilient portfolio. We are primarily invested in infrastructure and utility assets. And why do we invest in infrastructure and utility assets? Well, they're needed. They're basically essential for everyday life. They will always be needed. We'll always need waste assets. We'll always need water assets. We'll always need energy transmission assets. We'll always need utility generation assets. And a number of our investors always ask us, how does your portfolio, though, provide resilience? Well, I'm just going to touch upon a few of the sort of the macro and geopolitical uncertainties that we're currently seeing in the world and how we sort of mitigate those risks. And if we look at inflation, I mean, that's been a sort of a challenge for the last 2 or 3 years within the markets. And a lot of the utility assets are actually offer or concession contracts that are linked to inflation. So as we see inflationary pressures come through, those pricing or those inflationary pressures are able to be able to pass through to the end customer. Also, if we look on the infrastructure side, a lot of those assets have very monopolistic tendencies. For instance, Rumo in Brazil, it's the only railway operating that line. It so has a very good ability to pass through inflationary pressures to the end customer. And again, we've also seen a lot of energy price volatility over the last few years, and a lot of the utility assets on the generation side have been able to benefit from that. And again, those companies that operate in very monopolistic settings are able to pass through fuel price increases directly to the end customer. So therefore, energy prices haven't been too much of an issue for the companies in the portfolio. One other thing also, it's always investors ask is, emerging markets, they have huge, highly leveraged companies. They're very exposed to higher interest rates. Yes, emerging markets do have sometimes higher interest rates than developed markets. And as we've seen interest rates increase over the last few years, the emerging markets have been more exposed. However, they have managed to, or learned over the years, to manage this interest rate pressure that they're seeing. And actually, if you look at our portfolio, the average net debt to EBITDA in the portfolio is actually relatively quite low. It's only 1.9 times, which is a lot lower than everyone anticipates. Historically, in the past, sort of when I first started at UEM 10 years ago, a lot of the companies were taking debt out in US dollar because it was cheaper. But they've realized now that is not a great move for them. They actually tend to take out debt now in local currency, so the FX risk is mitigated. And the fourth risk that we always get asked is about geopolitical tensions. But as Charles has just mentioned, look, actually, the reshaping of the competitive environment in which we're currently seeing and the polarization of us, the political world in which we're living, is actually providing UEM with great opportunities in which for us to invest. So at the moment, therefore, we can see UEM, by investing in utility and infrastructure assets, is offering protection in the difficult macro and geopolitical environment in which we're currently living in. And then if we look at the portfolio itself, as Charles has already mentioned, look, we have a very differentiated, benchmark agnostic portfolio. We are bottom-up managers. We are very active in what we do. And you can clearly see this on this slide. If you look at the sector split and the geographical split, if you look at the sector split, you can see that actually, if you add up all the utility exposure that we have, it's around 40% in the portfolio, versus that which is in the MSCI Emerging Markets Index, which is about 3.1%. We're therefore incredibly different. This is how we're showing how active we are and how we are managing to trade differently than, I suppose, another MSCI Emerging Markets Index, which might be Emerging Market Fund, which might just be tracking the index. We're not interested in the consumer discretionary companies or the Alibabas or the Tencents in the world. We are interested in those infrastructure and utility assets which give us those long-term, stable, cash-generative, I suppose, resilient to cyclicality stocks. And then if you look again also at the geographical split, we can see how different we are. Our biggest exposure at the moment is in Brazil at 23%, and we have got a very limited exposure to China at the moment of 12.4%. And we can come on to talk about how China's doing on a macro level later on in the presentation. But also what I really want to sort of just make one more point on that slide, sorry, Mark, is actually, look, we are very much focused on the infrastructure utility assets, very much focused on today's need and tomorrow's innovation. Infrastructure utility is always going to be needed in the world that we live in. We are able to target our investments and look for, as Charles said, those high investment returns, because we don't track the index. We don't have to be invested in the Tencents and the Alibaba. We're also closed-ended, which means we can take a long-term view. We don't suffer redemption risks, and therefore we can have a very active strategy and ensure that we are maximising returns for our investors. If we then look quickly at the portfolio construction, I've already sort of briefly touched on the sector and geographical split and how it breaks down our portfolio, which is on the left-hand side of this slide. But I just wanted to point out how the portfolio is currently looking. We have approximately about 70 holdings in the portfolio. The top 30 make up about 73% of that. And we only invest in we will primarily invest in equity investments, but we can invest in bonds and convertibles if we find the right opportunity that, again, provides us with a good return to our investors. Typically, we take no position over 10% or one stock investment over 10% in the portfolio. Currently, FPT is just over 5%. And we've let that run up a little bit because of the strong performance of that stock. And we are closed-ended, but turnover in the portfolio tends to be around about 25% of gross assets per year. And also we do have the ability to add gearing into the portfolio. We have a debt facility of around 50 million. pounds. At the moment, we've drawn down around 20 million. And we can invest in unquoted, but that is very minimal at the moment. That is only around about 3.1% on the portfolio.
Thank you, Jax. So what does this all look like? If you want, looking at the opportunity and looking at the investments that we've made over the time, what has it delivered? It's delivered a strong NAV performance. I think you can see here the dark blue line for most of the period is well above the MSCI, and we think that with confidence we can expect the opportunity to look the same going forward. We do build 5-year models, and therefore for our investments we have a high level of visibility and outlook. NAV's compounding just under 9%, which is a strong performance since inception. Our total NAV is up 420%, and while the shareholder return is lagging and a real frustration to us, that's the market, if you want, determining the valuation in their eyes for a trust in the UK. And we will work hard to close the discount. But our number one job, deliver the NAV performance and achieve the returns that we can see available to us. Next page, Mark. If I look at dividends, an outcome of investing in operational assets that are generating free cash flow and very often being very firm on dividend policy, we see that over 80% of our portfolio today pays a dividend. And that enables us in turn to pay a dividend to our shareholders. From 2007 to 2024, the compound growth has been 7.5%, which I think is a strong performance. A current dividend yield is 4.4%, and that's driven off the last quarterly dividend that we announced at the back end of last month of 2.325p, which is a step up on the quarter before of roughly 8%. So if you want, the dividend growth, which here is up to 2024, should continue into 2025. And the current yield, as Jack says, 4.4% is a good return, notwithstanding anything else. And I think enables shareholders to buy the shares and hold them, wait for the capital performance to come through. Outlook for 2025. And as you can imagine, if you want, our views and expectations do change. There's been a huge amount of electoral outcome over the last 12 months, from Indonesia through to Mexico through to India, but of course the US, where Donald Trump has been elected and clearly has a strong policy in terms of trade, and we'll have to see how that plays out. But what I would say for 2025 is, while we expect trade friction to escalate, and we certainly anticipate a strengthening of inflation, we don't think over the entire year this will disrupt the performance of our portfolio. We think that our assets are uniquely placed to withstand the challenges in the wider economy, and we think our management teams have demonstrated over time their ability to achieve above average growth and above average returns. Having been in Asia and been to Indonesia, Malaysia, Philippines, and Singapore, my one observation would be, I think everybody expects a slowdown on GDP growth in the first 6 months. But then they expect it to revert to a normal trend. What does that mean? It means for somewhere like India that the 6-7% growth rate may turn out to be 5-6%. But for us, that's still a good growth rate. As we've said before, if India grows at 5 to 6%, we know that their, if you want, number of TEUs that go through their port will grow above that. We know that energy will grow ahead of that. So the backdrop, while mixed, I think presents us with real opportunities. China continues to disappoint. They have not delivered enough policy decisions to properly drive consumer behavior. Their consumers are very much hunkered down, very much in, if you want, risk off and accumulating capital. And the Chinese government to date hasn't achieved a shift in that behavior. What I would say is it's good to see that the Chinese government is engaging. It's good to see that they are constantly looking to change that outcome. And I have no doubt that they will get there. I think with some understanding, they don't want to create another bubble in the housing market. With some understanding, I think they also want to understand the nature of, if you want, the trade relationship with Trump under Trump 2.0. And that outcome may be what's causing them to be a little bit hesitant. But they certainly have the tools within their, if you want, toolbox to address the consumer, address the weak property market, and therefore drive the internal economy, which we all need to see. I think in terms of just the closing note, despite the challenges, I think the emerging markets will deliver growth in line with their long-term expectations. Interestingly, having touched base with a number of our investee companies, I think they had a good third quarter. I think a number of them are going to have a good fourth quarter. Some of that is driven by, if you want, trying to get ahead of the Trump presidency. I think they anticipate a slightly weaker next year, first quarter, second quarter, but I think they all expect to then be back to a growth metric, which will deliver the outcomes that we need and are certainly achievable. So despite the macro, if you want, volatility, geopolitical uncertainties, I think all the drivers will remain in the portfolio over the next year at investee level will deliver. So why UEM? I think the point we are looking to drive here is we offer a unique exposure to the emerging market drivers, structural drivers in terms of middle class and urbanization, but also the megatrends, the energy transition, the digital investment that is happening at pace. And that unique exposure is, if you want, underpinned by long-term business models, long-term investments. I think the second point, real assets driving compelling returns. These are assets which very often drive an EBITDA of 25, 50, 75%, and therefore are hugely cash generative and hugely valuable in their nature. Clearly, we believe an experienced management team with decades of investment in this space, decades of understanding as to what really drives a business opportunity. And that's invaluable. And clearly, strong performance. I think that should encourage investors, particularly at the moment, given the discount, given the yield. So we think UEM is a compelling investment at the moment.
Yeah, and just to bring the portfolio a little bit alive, so you can get a bit of a flavour of some of the investments that we were making. One of the investments that we have in the portfolio at the moment is TAV Airports. It is sort of playing that sort of social infrastructure megatrend, that drive of the increase in the middle class, which is then pushing forward the propensity for individuals to travel. And TAV is really, really benefiting from this. It currently operates 15 airports in 8 countries. It's got 5 in Turkey. The rest are in Kazakhstan, Georgia, Tunisia, Macedonia, Saudi Arabia, Croatia, and Latvia. But it also offers services within duty-free and ground handling. So actually it has a presence in over 110 airports globally and in 33 countries. Passenger growth currently is very strong for TAV. In 2023, it witnessed, I think it was 21.9% increase in passenger volumes and handled 96 million passengers. The company itself, though, look, why do we like it? It has high quality assets with long-term concessions. The airports that it operates, it wins the concession for it, and therefore it has a set period of which it can operate. And it's a very monopolistic business model. The airport's fees are often in hard currency. What do I mean by that? Well, the ones in Turkey are in euros, so therefore pressures of the Turkish lira they don't feel as much, because obviously they're earning revenues in euros. As I've already mentioned, they've had strong passenger growth this year. They were expecting low double-digit growth, but still very strong. And we're forecasting for the next 5 years growth between 7 to 10%, which is a lot higher than other European airports are currently seeing. The group also has very good corporate governance. ADP, which is the French-listed airport operator, now owns 46% of the company. And they've come in, and what they've been able to do is really transform the non-aeronautical revenues, which is basically the duty-free spend in the airport, and really push that up. And we've been able to see that slowly come through in the financials. And the company still is relatively quite cheap. It's trading on single digits PE and EV/EBITDA multiples, so continues to offer us good, attractive returns in the long run.
Okay, so an example on the digital infrastructure side, as Charles mentioned, there's a big transformation across the globe in digital infrastructure, and this is happening, in developed markets, but also in the most frontier markets. And one company where we're invested is a company called Sonatel. It's a company that's been in the portfolio for a number of years, but has done particularly well this year in terms of share price, and has now come into the top 30. And really here we're looking at a big mega trend, which is a move towards the internet in these countries. Sonatel operates, I should say, in Senegal and some neighboring countries in West Africa. And it's primarily a mobile operator. It's got about over 40 million customers. But what we've seen over the last few years is a rapid transformation from people from using just voice and SMS services to 4G mobile internet services. So if you look at the blue line, the blue columns on the graph in the bottom right-hand corner, this is the number of 4G or mobile internet customers that Sonatel has had. Last year they grew over 35%. This year we're on course for a growth somewhere in the mid 20%. And when people move from voice and SMS to data, what you find is that the spend transforms from being discretionary, where you make a decision to make a call, send an SMS, to something that's much more an everyday part of your life, much more essential. So people are topping up on a weekly or daily basis in these markets to use the mobile internet. And so why we are investors in this company, as we said, we've seen very strong growth in mobile data, 4G data, and they're starting to move into 5G. Although it's a very small part of their business in terms of number of subscribers, in the more prosperous areas of Dakar and other big cities, they are now installing fiber broadband, and we're seeing very strong growth in fiber. And another characteristic of African markets is the integration of payments into the mobile service. So this is what they call mobile money. Internet penetration, as I said, remains relatively low. Of the mobile users, only about 40% are currently using the internet. So there's still more strong growth to come as prices come down. We also like, similar to TAV, the fact that you've got a big European shareholder involved in this company. This is Orange, which used to be France Telecom, is the largest shareholder. The other big advantage of this company is that its revenues are generated on a majority basis in XOF, which is the West African franc, and this is pegged to the euro. So we've seen these strong growth metrics in users in many parts of Africa over the last year or two, but in many markets like Nigeria or Kenya or Egypt, we've seen big devaluations of the currency, which has been a big headwind for investors, whereas at least with Sonatel, we are pegged to the euro. The company generates strong cash flows, has a strong dividend yield, and although the share price has gone up very strongly this year, still remains very cheap. It's on the EV to EBITDA of about 2.5. Its P is about 7 times, and its yield at the moment is 7 times. It keeps increasing its dividends. It's got a progressive dividend policy.
Brilliant, thanks, Mark. Another investment they have in the portfolio that is sort of playing that sort of energy growth and transition mega trend is IndiGrid. IndiGrid is an investment trust actually listed in India with a market cap of around 1.2 billion. It currently has around 8,700 kilometers of transmission lines under management, and it's sort of moved more recently into solar generation, and it has 1.1 gigawatts of solar assets in its portfolio. Why do we like IndiGrid? I mean, I've just come back from India, actually. I was in India for 2 weeks and traveling around, meeting a lot of the companies within the portfolio and also new opportunities. But why do we like IndiGrid? Well, it's really clear from our travels around India that energy or India's rising power demand and green transition is definitely at the forefront of that market. I mean, India are expecting over 500 gigawatts of renewable energy to come online by 2032, which means IndiGrid is really, really well placed. But IndiGrid is really incredibly good operators of the assets or the transmission lines that it operates. They're always achieving over 100% availability for its lines. But the real reason why we love IndiGrid is because transmission lines is very visible what the cash flows are, and they're very stable because you will bid for a transmission line for a set period, and you know what your tariff is going to be over that period. So therefore, we can see what the cash generation is going to be and over what period, and therefore we've got very good visibility on that. They have, like I said, moved more into solar assets at the moment, but they are continually adding assets at the moment, and they've been able to more than double their EBITDA, therefore, over the last 5 years. And also as a result, because of the structure of IndiGrid, it is actually an investment trust. They do have to pay out 90% of their net cash flows, which means at the moment we are, as investors, earning a dividend or a yield, on this stock of 10.5%, and that dividend is paid quarterly, which is also very attractive to us. But another reason we love these guys is that actually the management team of this company is very good. It is an investment trust, but it has an investment manager, and that investment manager is KKR. They used to be shareholders, well, they are still small shareholders, but they have sold down. But the investment manager is still KKR, and they are incentivized to grow this investment trust by obviously injecting asset, and they will receive an additional management fee. But in order for them to receive it, they have to make sure that the investments they inject into the fund are accretive to all shareholders. So the DPU is actually increasing as they inject in assets, which means, again, that these guys are going to grow this fund because it's in the minority shareholders' interest as well as their interest. So we are seeing huge opportunities here come through. And then the final stock that we're going to talk to you about today, we've spoken in the past about, is ICT, playing that sort of global trade infrastructure mega trend that we're seeing, the diversification of supply chains, and ICT continues to be well placed. It operates 33 terminals in 20 countries, mainly in emerging markets, and has a market cap of around 7.4 billion listed in the Philippines. Why do we like these guys? Well, we've seen 25% growth in volumes over the last 5 years, but its EBITDA has risen more than 81% over that period, and with EBITDA margin continually expanding, now around 65.4%. Because what's great is this management team are able to take on, I suppose, poor ports that are not performing, rip out any excess cost and really drive cost-cutting measures through and push volumes through. And because of the huge operational leverage that we're seeing with ICT, they are able to drive margins and therefore see that growth coming through. And that is being clearly reflected by the market in the share price performance. Like I said, management are great. They're a very strong management team, and they have been able to expand margins, and they are continually looking for new opportunities of ports that aren't performing to add to the portfolio. So we continue to see that growth coming through, and they also are not too expensive, still trading at 11 times EBITDA with a yield of around 4 or 5%.
Thank you, Jackson, Mark. I hope that gives some visibility on, if you want, the quality of the assets that we're invested in, but also the quality of the management teams and the delivery over time. So just as a closing slide and trying to capture everything that we have talked about today, the portfolio is cash generative and operational assets. And that, as I said, gives us real confidence in these businesses and their outlook for the next 5 years. As Jax has covered, very compelling investment valuations. For businesses of this quality, the valuations are cheap. And as and when, if you want, confidence returns into the emerging markets and especially the local markets, we expect that to drive the NAV upwards quite firmly. Assets that are resilient through economic cycles, if you looked at all of those profiles we've given you, they are growing their revenues over time. They are widening their EBITDA margins. And that, to me, demonstrates real resilience, recognizing, in recent years, not only have we had change in governments in a lot of these countries, but we've had COVID, and those challenges these management teams have risen to. And as Jax has eloquently set out, very differentiated from the MSCI Emerging Market Index. And we think that's a strength and a reason to be an investor here. In terms of the right-hand side performance, long-term performance, outperforming the MSCI. And while I can't be certain about where the MSCI goes from here, what I can be fairly confident about is our investee companies' ability to deliver on their business models and therefore drive the performance of our investments. A covered and growing dividend. Our dividend has been covered all the way through, including COVID, and I think that's a strength. We pay it quarterly, and I think that's, again, a strength. Highly active share and consistently low beta. I think these are just outcomes to note for investors. But it would be difficult for others to replicate what we have put in place with all our knowledge and all our in-depth understanding of these businesses, and clearly a specialized investment team. This ought to enable us to respond to the challenge which will no doubt come in the emerging markets over the next 12 months, but we can look to it with confidence, especially with the bank facility, which will enable us, as at times high conviction investors on individual stocks, to enter the market and top up if the opportunity looks particularly cheap. And my closing comment is, nearly 9% over 19 years and a dividend yield of 4.4%, I think ought to be a compelling entry point for shareholders. So thank you for joining us today.
Fantastic, Charles, Jacqueline, Mark. Thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jacqueline, as you can see, we have received a number of questions for investors today. And at this point, if I may hand over to you to chair the Q&A, and kindly ask you to read out the questions. I'll pick up from you at the end. Thank you.
Cheers. Thank you very much. Thank you for all the questions that have been submitted. So the first question that we have in, probably for Charles, is how will you sell the holding in UEM in order to wind down your other trust?
So I think, unfortunately, UIL, which is a shareholder in UEM, needed to redeem its ZDPs, which it did on time and in full. But through that process, did sell down UEM. And sitting here today, we have a holding of just under 5%, and I would expect that to remain in UIL's portfolio going forward.
Okay, brilliant, Charles. The next question that we have in is, are there any specific strategies being considered to narrow the discount to NAV beyond share buybacks?
So at the moment, our policy is to buy back shares if the discount is wide, and clearly we share the shareholders' frustration, and we believe it is something that we should be buying back. I think part of the discount is driven by the wider market. I don't think it's just UEM that's trading at this level of discount. And the wider market is clearly looking at fixed income and is disinterested in, if you want, the equity market in the UK. It's hard to see what closes that discount. What we are doing is actively marketing the investment opportunity. So we are much more active on LinkedIn, and a number of you I know do follow us there. We are active in going out and seeing shareholders and making sure they understand the story, such that when sentiment does shift, we are the first buy that people will make. And I think that is the best defense in terms of trying to narrow the discount over the coming years.
Yeah, thank you, Charles. I mean, just to add to that, I mean, we have been actively buying back. I mean, we bought 1.9% of the share capital as at the 31st of March this year back so far. We are marketing to try and reduce that discount. Another question coming, just sticking more on sort of the operational side of the questions, is, are the trust dividends covered by earnings per share? I think Charles has already mentioned just on the last slide that yes, they are, but just to also add, we have around 6.8p in reserves as well, if needed. Another question that we've got come in is also, are there any regions or sectors currently underrepresented in the portfolio that we're actively exploring?
Look, I think the interesting thing is, having been to Asia, and as you know, Jack said she went to India, and Mark's been to a number of countries in Asia. Also, having been recently in Greece and Turkey, and Jack's being in Poland, what is evident is that the investor pool is widening. And there are these drivers, as we've identified, which are throwing up real opportunities. So yes, I think we are on the front foot. I think there are opportunities. As ever, they need to demonstrate to us an ability to deliver real performance to the upside. But to give you maybe one, and I hope Jax excuses me, but you know, Piraeus Port, which has gone into the top 30, is classic investment for us. I mean, Jax, you might want to touch on it.
Yeah, Piraeus Port is a Greek-operated or Greek-listed port operator. It's currently handling around, I think it's 5.2 million TEUs. I mean, it's been something that's been on our radar for a long time, but what we're now seeing is sort of strong growth coming through of volumes again. But there's been a real improvement, I suppose, in the way in which the port is operated. And therefore we are seeing strong operational leverage now coming through. But one of the big changes, I mean, similar to, interestingly, like we mentioned with TAV, with ADP airports coming in, and Mark talking about Sonatel, about the European investors. What we like about the Greek port operator is actually 61% owned by COSCO Shipping, which is the large Chinese port operator, and these guys are incredibly efficient at driving volumes through that port and therefore driving the returns, and Piraeus Port has therefore been able to benefit on the back of that agreement they have with the terminals that are now directly operated by COSCO. So that's been a solid investment for us, and hence the share price is now slowly starting to reflect that operational performance that the company has witnessed over the last few years. Just linking into that, another question that we've also had is there don't appear to be any investments in Argentina. This is the economy that is doing really well under the new president, Milei. Are we investing into Argentina? I'm happy to sort of try and answer that, Charles. I mean, look, I think as Charles mentioned, we are looking at the individual opportunities at the moment. And yes, Argentina has benefited off the back of Milei. I think we've been sort of on the sidelines there, watching very closely what his policies will mean. Yes, the market has reacted, but we're still trying to see how those policies do flow through, and if actually they can be sustained, because we've seen this story quite a few times with Argentina of 2 steps forwards and then 1 step back. Is that fair, Charles?
That's fair.
Yeah. Okay. Another question that we've got is, please make some comment on the big investment decisions and the rationales behind them that you've made in recent months.
I think, Piraeus Port is classic. We're looking for investments where there is a good asset. So Piraeus Port is perfectly positioned for imports into Eastern Europe and Europe itself. And, there's been a change with the incoming shareholder in the form of COSCO. And those two things have driven an outperformance. And I think if you look at TAV Airport, same answer. So there are opportunities, and I think the fundamental driver is finding assets which are attractive, undervalued, but then understanding how that undervaluation will be unlocked. And it would appear to me there is a growing pool of assets that meet that expectation. But at the end of the day, we're looking for investments which over the long term can deliver. I think one of the strengths is finding the asset, but also finding the management team that can unlock value over time. ICT has been in the portfolio since day one, I think, and has been in our number 1 position for, I think, nearly a decade, and with real justification. They've been able to, if you want, grow their volumes 6-7%. They've been able to grow their revenues 15-16% because they can price on top of volumes, and they've been able to grow EBITDA 25%. So all in, if they can continue that metric and that momentum, they'll stay in the portfolio. So it's not just a question of finding new investments. It's also, I think, making sure that they can deliver over the decade.
Yeah. And then I suppose linking into that is one of the questions that we have is, do you have minimum corporate governance standards or criteria which companies must meet to include in the portfolio? I'm happy to give that one a go, Charles. I mean, look, at the end of the day, what we're looking for is companies that are well managed, and typically when they're well managed, but also look after the interests of minority shareholders at the same time. Do we have those strict criteria of it has to be a board that's totally independent? No, because actually if you look at ICT's board, it's not independent. However, we've flagged this a number of times with the company and said, look, it should be independent. But what gives us comfort is that actually management continually operate the company in line with minority interests as well as what the main shareholders' interests are as well. So therefore, we can get comfortable on that. I don't know if you want to add anything more on corporate governance, Charles. I mean, it is the bread and butter of the investments that we make.
Yeah, look, governance has always been high for us. It's a key feature. We need to understand who our fellow shareholders are, what their objectives and ambitions are. And we need to understand that they can deliver in the environment in which they're in. Jax has very well approached ESG, and we have our own internal metrics, which is here on page 26, which is in the deck. What I would say is it enables us to not only score, if you want, ESG, but enter into an active dialogue with these companies around where they can make improvements, because there's no doubt that shareholder retention does fall in this area. What I would say is from time to time, the portfolio may have more, if you want, if we use fossil fuels, it may have more fossil fuels. If we feel the returns are there, we will still look to that company to improve all the metrics that they can over time. So I think we are looking for our investees to go up the curve in terms of ESG, but not be beholden to, if you want, the ESG hurdle.
Okay. One of these questions I always really like is, you've shown us the holdings which have done well. Which of your holdings haven't done so well? And what was the reason for that?
I think if you looked at the investments which haven't done well, they've either misstepped on their expectations and their delivery, and or there's been a change in, if you want, government policy, and therefore, if you want, underperformance. And we do have them in the portfolio. And there are some that are frustrating in nature because the opportunity remains there. Good asset, good opportunity, but they've failed to capture all the upside. What I would say is, if we determine that there is a fundamental change, we will sell out. We're not, and hence the 25% churn. I think we are active. We don't. Because we're not trying to look to meet an index, we're trying to look to performance. But there have been investments in power transmission and others where they failed to deliver, and we've exited.
Yeah, I'd agree on that one. I mean, like I said, we're very active in our investment research and everything we look at, but sometimes going to give the example of toll roads, Charles, in China, for instance. Probably more than 10 years ago, we had a few toll roads in China which were cheap, giving us a fantastic dividend yield, strong growth, as we saw, again, social infrastructure playing through, people buying cars, etc., etc. And that was great. They were great assets to hold. But overnight, the government announced that on public holidays, the toll roads would not be able to charge tariff, so effectively it was free, and that was overnight. There was no visibility on the policy change, and therefore we could definitely see earnings would decrease by about 10%, 20% because of the back of that. But that, unfortunately, was something that you can't foresee. So, but where we can mitigate the risks, we do try to. Last question.
Just to complete the toll road observation, the Chinese government did extend the contract or concession as a way of compensation. But I think, we look at it as we were looking for cash flow to marry our expectations, and being rewarded at the back end is just not the same as being rewarded early on in the concession, and we sold out.
Yeah. I mean, as concessions contracts are very much the bread and butter of a lot of the investments in the portfolio. So we're often investing into countries where concession contracts have been highly respected. And if there is a change in the concession contract, that actually the return on the concession contract still remains the same over the life of the asset. Whereas we've learned, or we know from China, that actually sometimes the concession contracts can't always be immediately changed, like in the toll road sector. But at the long term, you will get the return back. But sometimes it's not always that clear. But that is China for you. Hence, probably why it's underweight in our portfolio at the moment. Last question. I understood that UIL is winding up over the next few years. What will happen to the remaining 5% holding?
So UIL is not winding up. UIL is going to go private. It'll stay as an investment vehicle, and it will be private. I anticipate the holding in UEM will remain.
Yeah.
Perfect. That's great, Charles, Jacqueline, Mark. Thank you for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. Charles, before redirecting investors to provide you with their feedback, which I know is particularly important to the company, could I please ask you for a few closing remarks to wrap up the meeting?
Well, first of all, thank you, everybody, for joining us today, and everybody who looks at this recording. We really appreciate your communication and hearing from you. We hope that you share our enthusiasm and passion for the emerging markets, but even more so, UAM's particular opportunity, about which we are very excited. But thank you very much, and have an absolutely fantastic break over the Christmas, and look forward to meeting many of you in the new year. Thank you from all of us.
Fantastic, Charles, Jacqueline, Mark. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of UTILICO Emerging Markets Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.